Hello and welcome to Boston. I'm in the office of GRT Capital together with Tim Krochuk, who is the managing director of GRT Capital. GRT Capital has just formed, or actually not just, it was in 2009, formed a joint venture with Denver Investments. Denver Investments is a traditional long-only company, and this is basically a trend that will, we believe, accelerate over time, that the traditional long-only houses are reaching out and forming alliances and joint ventures and possibly also mergers and acquisitions with players from the alternative industry, with a hedge fund, in this case here, GRT Capital. Tim, tell me more about this joint venture. How did it come about, and was it something that you were trying to achieve, or did Denver Investments approach you?
Yes, actually this is a venture that both of us were looking for, and we had both considered other parties. It just so happens that in our case, the GRT and Denver had very similar philosophies and had the right fit. The reason that we were looking at all, and of course the reason I think that Denver was looking, is that everybody agrees that alternatives are going to be a larger and larger piece of institutional portfolios going forward. Even Harvard now has it somewhere around 35–40%, quite an increase. The traditional long-only manager, like Denver, who's been around since 1958, they have $8.5 billion under management. They know that it would help them to have some alternatives capability with their existing relationships.
Tim, what capabilities and what strategies are you actually adding to Denver?
GRT Capital Partners is a collective of independent managers. We're a boutique firm, and all 10 of our managers with all 10 strategies are now available to Denver on their platform. Those are 4 core strategies, which include a long-only value, a long-short value, an opportunistic long-short, which goes between value and growth, and a European market-neutral approach. We have 3 sector strategies, all long-short. So we have technology, healthcare, and natural resources, all long-short strategies. And then we have 3 specialty strategies. These are somewhat unique. One of them is a closed-end fund-to-funds. So it's a long-short product, but invests only in closed-end funds at 60% equity, 40% bond mix. We have a microcap, which mimics public-private investing, if you will. It gives you private equity-like return stream, but with a public pricing on a daily basis. There are larger investments in these microcap equities. And then the last strategy is an ETF strategy that does global macro across 14 ETF sectors. So it's currency, commodity, equity, U.S. and foreign, and bond, U.S. and foreign. So all of those capabilities are now available to Denver Investments' underlying investors without any disruption to Denver's current lineup. That's probably the most important piece for Denver's perspective. They suddenly pick up all of these managers, some of whom have records as long as 8 years actually investing in the long-short space. But they get it overnight without burdening any of their existing portfolio managers to learn or try something new. From the investor's perspective, it's a win because they get the stability and size of an $8.5 billion firm that's been around since '58. But they pick up our track records, our back office, and our trading expertise in the long-short space, which has been 9 years in the making. So rather than creating a new product, we've really just combined 2 existing firms to create we think, a very powerful product.
So that's a model that you certainly can recommend to other people to follow?
I believe so. You know, obviously with any merger, and although this isn't a merger in the sense of a true merger and acquisition where money changed hands, but in any mix you have to make sure the philosophies among the managers remain constant. One of the reasons this worked for us with Denver is that they think about their investments the way we do. They put the client first like we do. They're very much an independently owned boutique like we are. So the philosophies between the 2 firms naturally meshed. Also, the sizes worked well. I'm not sure this would have worked if we had done this with a $100 billion firm, because we would be such a small piece. We really couldn't move the revenue line for the firm with a great deal of success. On the other hand, if they'd only been $800 million or $1 billion, that wouldn't have worked either, because we would just be a couple of smaller firms, trying to do this arrangement. So I believe that it was the Goldilocks solution for us. We found the perfect size with the perfect personalities, and now we think we've created something very special, and we hope the investors will agree.
So when two units come together like this and form a joint venture, obviously, you are a business, they're a business, and you want to increase and grow, and obviously you would have made a business plan and projections into the future. Tell me more about what are you trying to accomplish now in this new combined unit?
Sure. Well, obviously, besides picking up the size and scope of Denver, and Denver picking up our track records and experience in the alternative space, we, as you guessed, did take this one step farther. We've created a new structure which we think does not exist in the same form anywhere else right now, and we're very excited to make it available to institutional investors. So that's really what we're launching with this new venture. The structure is called United Alpha, and United Alpha is an idea that came really out of the chaos of 2008. We now have combined inside of Denver Alternatives this group of 10 investors with 10 very different uncorrelated strategies. We're making them available to the institutional audience in a single account. So all of the due diligence becomes very easy now. It's one trading desk, one ADV Part 1 and 2, one sort of compliance to learn and understand. Any mixture of those managers can be combined in that account. And here's where it gets special. First of all, you can change that mix daily. So there's no more artificial liquidity constraints. The idea of waiting till the end of a quarter, the end of a month, or waiting 45 or 90 days, it's gone. If you think you need to do something with your assets, you can do it today, and we will effect that change for you. We will start to effect it the very day that you ask for it. And second, transparency. We're making it very easy for you as the client to understand exactly what you own. And when I mean exactly, we're talking about a level of detail you don't normally see from, say, a traditional fund of funds. The traditional fund of funds, if they're invested in 10 managers, has to collect 10 reports from those 10 managers. It's very unlikely that the reports look exactly the same. They're going to have different industries, different sector definitions. They're going to use different definitions of leverage and perhaps beta. So, I feel for the fund-to-fund manager who has to try to combine those 10 reports to give the underlying investor a picture of what they really own. We eliminate that problem. Every manager trades through our desk. Every manager sits on the same platform here, so we can tell you exactly what you own by sector, by market cap, by industry, by country, currency, and all of the fundamental data that you've come to expect, price to book, price to sales. And every stock is being viewed through the same lens. Every strategy, every manager, same lens. So you have an exact picture of what you own every day. In fact, if you want it, you can get the daily liquidity, including trades, every day. I'm not expecting every investor on the institutional side will ask for it, but it's there for you if you decide you need it. And finally, and probably this is the most exciting piece, we're netting the fees. For investors who don't understand that concept, sometimes in 2008, there were funds that were down for the year, and that's not a big surprise given how difficult it was, but some of the individual managers may have been up, meaning that you as an investor, as an institution, may have paid a performance fee even though your fund went down. And that probably didn't sit well with many investors. And it doesn't sit well with us. That should never happen.
In fund of funds.
In fund of funds, but also even in managed account platforms. If you're paying every manager separately and one manager has an incredible return and the rest of the managers have a terrible return, the way it works today, that manager that had a great return gets their performance fee, even though you are poorer, in the big picture. We're eliminating that problem. If you invest in a United Alpha product, whichever combination of managers you choose, we're netting their returns. In other words, if the overall account is up, you pay on that performance. If the overall account is down, even if some of our managers made you money, you don't pay us anything. We think it's transparent, we think it's reasonable way to charge fees, and we think it'll be very exciting. We've looked at it, and if you were to just take an equally weighted mix of our strategies through time, now again, this fund did not exist through time, but if you were to just take our real audited strategies through time, that's given you 200 to 300 basis points per year of additional return by netting the fees. So this is a really valuable component to the UAA. So 10 new managers, they're willing to work for you in one account to make it easy for you to do the due diligence. They're willing to give you netting, daily liquidity, and daily transparency. And we don't see that product in its same form through one trading desk all under one company with the quality of management that we have here anywhere. So we're very excited to provide that through what will be known as Denver Alternatives.